You've been telling us to expect lower returns in the next, not just next year, but in the next several years. Why should we be expecting lower returns?
Well, Matt, your starting place matters, and we're starting at high valuations right now. And with high valuations, the math is that when you have high valuations, you should expect lower returns. The only thing to bail you out is exceptional earnings growth, and we just don't see that from the economy right now.
Great. Now, the market's been more volatile recently, but as you pointed out, it should be more volatile. It's getting back to a more normal situation. Could we expect to see things a little more volatile than they've been in the last few years into 2019?
Well, when you and I first came to the markets, this is the type of volatility we would see. Extreme monetary policy kind of put a damper on that volatility. We would expect this type of volatility going forward. And we think it's healthy for markets to have this kind of volatility. Maybe not the extremes day to day, but you should have some volatility. It reminds you to always rebalance and keep risk constant in your portfolio.
Last question about retirement and where we're going. It's a tough situation for the baby boomers. Generically, we haven't saved enough overall. Does the retirement industry, which is essentially what you're helping represent here, have any thoughts about how we can expand retirement, how we can expand the pie a little bit? The problem is very simple. We've got to get people to save more because wage growth isn't going to do it necessarily. As you say, market outperformance may not do it. We're stuck.
So if the markets aren't going to rescue you, what can you do in your own portfolio? You want to max out your tax-deferred vehicles, and you want to max out your savings and keep costs low. That's the thing. Those are the things you can control. Get your savings up, right? Keep your expenses of your investments down. You do that, you're doing your part. And then once you're in retirement, you have to manage your expenses according to what you have and not draw it down quickly. That's how you can do your part on the retirement side personally. And overall, what we hope to do is actually low-cost advice is something we can bring to the market to help people invest even better.
Finally, your economic outlook for 2019 headline two risks. One is trade wars continuing, and the other is the Fed getting too aggressive. Can you just very briefly, if the trade war suddenly went away, would that be a significant help to the market? Then I know you're not an economist, do you have any thoughts on where the Fed might be in 2019? Are they going to keep raising?
Well, if the trade wars went away and then you had sudden growth come back again to the economy, the Fed would probably keep raising rates, especially if you see things like inflation picking up. You see tighter labor market with wage growth. They will continue to raise rates. So the fear is that they go beyond kind of what is that R-star rate, and then it becomes constraining to the economy. And that's the fear. And it's a really tough balance to strike. So it's easy to say the risk, tough for us to say, well, here's how to get it right if you're the Fed.